lecture, we are going to be looking at the dividend decision. Now, up front, it's extremely important that you understand that investor or shareholder returns consist of both capital gains and dividend returns. A mistake commonly made by students is you tend to focus on the dividend return and you forget about potential capital gains. So guys, let's say, for example, you've been provided with a scenario and there's a company that does not pay dividends. So this company never pays dividends. You can't say that shareholders don't get any return on their investments. You are correct, they don't get a return in the form of dividends. However, hopefully one day in the future when they sell their shares, they'll make a capital gain on the sale of their shares, and the return is then obviously in the form of capital gains. So please note, when we are looking at the returns that shareholders get on their investment, you need to consider both capital gains and dividend returns. So companies must strike a balance between providing shareholders with a satisfactory dividend return and also keeping enough money in the business to fund future growth. So let's say, for example, guys, we have a company that pays very high dividends every year. If the company pays very high dividends every year, that means less money is going to be retained in the company for investment purposes. So in the future, if the company has investments with a positive net present value and they want to finance those investments using equity finance, because all of the money has been paid out as dividends, they are going to have to issue new shares in order to raise equity finance. Now, obviously, if new shares are issued, the market value per share is going to be diluted. So if you invest in a company that pays very high dividends, you will get your return, obviously, in the form of those dividends. However, future growth in the share price will be sacrificed. On the other hand, if you invest in a company that pays smaller or no dividends at all, that means that the money is being retained in the company for investment purposes. They are not paying out all of their retained earnings as a dividend. They are keeping the money for investment purposes. So in the future, when there are profitable investments, they won't need to issue new shares to raise equity finance. They already have the money in the company. They use that money. So if you invest in a company that pays smaller dividends or no dividends at all, obviously you are going to sacrifice your return in the form of dividends. You don't get a dividend. However, you will hopefully benefit from capital returns one day when you sell your shares. Now, I say hopefully because obviously, guys, these capital returns here are uncertain. Lots of things can go wrong and you might not actually make a capital gain one day when you sell your shares. So that is uncertain. But you are hoping that by sacrificing the dividend and not having a dividend every year, the company is investing the money rather, and that will cause the share price to grow, and hopefully one day when you sell your shares, you will make a gain on the sale of the shares. But please note, that is uncertain. It is not guaranteed. Now, guys, it is important to note at this point that successful companies have very different dividend policies. So there's no one-size-fits-all or one rule that should be applied for all companies. Different companies and lots of very different successful companies have very different dividend policies. Then, you must study these dividend ratios. You must be able to calculate the dividend payout ratio, the dividend cover, and also the dividend yield. Let's quickly look at each of these. The dividend payout ratio tells us the percentage of earnings that are paid out as a dividend. So we take the dividends, we divide by the earnings, and we get an answer as a percentage. So let's just quickly add some numbers over here. Let's say that the company paid dividends of 200,000 Rand, and they had earnings of 1 million Rand. So that means the company has a payout ratio of 20%. They are paying out 20% of their earnings as a dividend. Now, guys, the dividend cover is just the inverse of the payout ratio. So instead of saying dividends divided by earnings, we are now just saying earnings divided by the dividend. So using the same numbers as above, take the earnings, divide by the dividend, and you get a cover ratio of 5 times. And the cover ratio just tells us the ability of the company to pay the dividends and the likelihood of a cut. So obviously you want the dividend cover to be as high as possible, because then the company can easily pay the dividend and it's not likely that the dividend will be cut in the future. So a dividend cover of 5 times just means that the earnings cover the dividend 5 times. Now I said to you, so make sure you understand the relationships between everything over here. The dividend cover is the inverse of the payout ratio. So if we have a payout ratio of 20%, 1 divided by 20% gives me a cover, or a dividend cover, of 5 times. Alternatively, the payout ratio is the inverse of the dividend cover. So if I say 1 divided by the dividend cover, or 1 divided by 5, that gives me a payout ratio of 20%. So guys, these things actually tell us exactly the same thing. It's just a different way of presenting the same thing. The payout ratio tells us the percentage of earnings that is being paid out as a dividend, whereas the dividend cover tells us the number of times the earnings covers the dividend. Then you also need to be able to calculate the dividend yield. And the dividend yield measures the return that shareholders derive on their investment in the form of dividends. So you can see it's driven by the dividend paid and the share price. So we take the dividend and we divide by the market value of equity, or the share price. And this will also give us an answer as a percentage. Now guys, depending on the marks available in the question, sometimes you'll calculate all of those ratios and you'll still be short of marks. Please note, in addition to performing all of the ratio calculations above, you can also calculate movements in things. So you can calculate the movement in the dividend from last year to this year, or the movement in the share price from last year to this year. So you can always calculate movements in addition to the above ratio calculations. And you always calculate a movement by taking the current year figure, subtracting the prior year, and dividing by the prior year. Right. Now guys, most students don't struggle with the ratio calculations. There is no excuse also for not being able to calculate the dividend payout ratio, etc. You must study the formulas above. If you don't study the formulas, you deserve to fail. But that's not where most students struggle. Most students actually struggle with the discussion of a ratio that they've calculated. So you'll see I've included a framework for you over here. And you are always going to follow this approach when it comes to the discussion of a ratio that you've calculated. And that will make sure that you score maximum marks in your discussion. So guys, first you're going to interpret the ratio. Now the interpretation doesn't come from the information provided in the question, it comes directly from your lecture notes. What does the dividend payout ratio tell us? It tells us the percentage of earnings that are paid out as a dividend. What does the dividend cover tell us? It tells us the ability of the company to pay dividends and the likelihood of a cut. What does the dividend yield tell us? It gives us the return that shareholders derive on their investment. So first, interpret the ratio. Then, after you've interpreted the ratio, you are going to compare it to a benchmark. Now, the reason why we compare it to a benchmark is we don't know if the ratio is good or bad unless we have something to compare it to. So, for example, guys, above, we calculated a dividend payout ratio of 20%. You can't say that a payout ratio of 20% is good or bad because we don't have anything to actually compare it to. So what do? You look for information from prior year periods. You look for information from similar companies. So for example, you might be given industry averages or competitor information. Then you compare the ratio that you calculated this year to the ratio for the prior year. You compare it to the information for similar companies, and by doing that, we can say whether the ratio has improved or deteriorated, or whether the company is better or worse than similar companies. So we benchmark so that we can see if the ratio we've calculated indicates positive or negative performance. Now, when you are discussing this, guys, please note, you can't just say that the ratio has increased or decreased. Because if you just say the ratio has increased or decreased, you are not showing the examiner that you understand whether an increase or a decrease is positive or negative. So you need to demonstrate that you understand whether the movement is positive or negative. So the types of words that you should be using when it comes to your discussion is things such as improved, deteriorated, better, worse, positive performance, negative performance, etc. Don't just say increased or decreased. You need to demonstrate that you understand whether the increase or the decrease is positive or negative. Then finally, you are going to give possible reasons. So sometimes you won't be able to give a reason, but if you are able to give a reason for the improvement or a reason for the deterioration in the ratio that you've calculated. Then if we look at the different dividend payment methods, companies can either have a stable dividend in rand terms. So guys, if it's stable in rand terms, that means the rand amount remains constant. So let's say, for example, we have a company that pays dividends of 100,000 rand every year. So the 100,000 rand is a stable dividend in rand terms. So this method attempts to pay dividends that are going to be sustainable. They don't want a situation where they have to drop the dividend below 100,000 rand. They want sustainable dividends. So dividends will remain stable at 100,000 rand, and they will only increase those dividends when earnings show long-term sustainable growth. So if earnings show long-term sustainable growth and they know there's no risk of the dividend ever being cut, they will then increase the dividend above 100,000 rand. But it's important to note when we talk about a stable dividend, we are talking about a stable dividend in rand terms. As an alternative, instead of having a stable dividend in rand terms, a company might choose to have a constant dividend payout or cover ratio. So let's say, for example, we have a company and they have a constant payout ratio of 20%. That means they always pay out 20% of their earnings as a dividend. Or alternatively, if we look at the cover ratio, it means we have a constant cover ratio of 5 times. Earnings always cover the dividend payment 5 times. Now, it's important to note, if the company has a constant payout ratio or a constant dividend cover, then the dividend is going to fluctuate with any change in earnings. Obviously, guys, if you are always paying out 20% of your earnings as a dividend, if your earnings drop, the dividend will drop. If your earnings increase, the dividend will increase. So here, with a constant dividend payout ratio or cover ratio, the rand value of your dividend is going to fluctuate. So the dividend is a constant percentage of your earnings. It's always 20% of your earnings, but the rand amount is going to fluctuate with any change in earnings. On the other hand, with a stable dividend, the rand amount remains constant. Now, it's important to note, shareholders view a fluctuating dividend as more risky. So if the company maintains a constant dividend payout ratio or a constant dividend cover and dividends are fluctuating with earnings, that is a lot more risky for shareholders because every year the dividend is completely different. It's not stable. Now remember, guys, the relationship between risk and return. If shareholders are exposed to more risk, they're going to expect a higher return on their investment. So that means if a company has a fluctuating dividend policy, their cost of capital will be higher because shareholders want a higher return on their investment to compensate them for the risk that they are taking. So for that reason, directors prefer a stable dividend policy. So what we saw above, stable in rand terms. They aim to maintain a stable or a gradually growing dividend through time, regardless of any earnings fluctuations. And the reason for that is shareholders view a stable dividend policy as less risky. If they are exposed to less risk, they'll be prepared to accept a lower return on their investment, meaning that a company that has a stable dividend policy will have a lower cost of capital. Then just 2 important notes. Dividends paid should not exceed the profit earned in a particular year. Otherwise, the dividend will not be sustainable in the future. So for example, guys, you shouldn't have a company which makes a profit of 80,000 Rand distributing dividends of 100,000 Rand. Those dividends will not be sustainable in the future. And in addition to that, the availability of profit or retained earnings in order to pay a dividend does not guarantee that the company has sufficient cash available. So when you are looking at dividend payments, you shouldn't just look at retained earnings and say there's enough money in retained earnings for this dividend payment. You also need to look at the amount of money sitting in cash and cash equivalents because of the difference between cash and profit. Just because the company has retained earnings available doesn't necessarily mean there's enough cash available in the company for the dividend payments. If we then look at the dividend irrelevancy theory, this theory was founded by Miller and Modigliani, and they believe that the dividend policy of a company is irrelevant because investors are indifferent to returns in the form of dividends or capital gains. So in other words, they are saying the dividend policy of a company doesn't matter because shareholders or investors don't care if they get their return in the form of dividends or capital gains. They are happy with either. So guys, the logic behind this theory is shareholders can create their own dividend policy. So how can shareholders create their own dividend policy? Well, if a company pays a dividend and the shareholder doesn't want that dividend, then they can just reinvest the money in the company. So if they don't want the extra cash, they can reinvest the money. They use that money that they received from the dividend and they just buy more shares in the company. On the other hand, if the company does not pay a dividend and the shareholder needs that cash, they can either sell their shares or they can borrow funds to restore their lost dividends. So according to this theory, shareholders are indifferent. They don't care what dividend policy a company has because they can create their own dividend policy depending on their own personal requirements. So guys, if the dividend policy is irrelevant, in terms of this theory, what a company should do is they should always invest in projects that have a positive net present value, and then any money that's left over after investing, that residual figure can be paid out as a dividend. Now, the problem with this theory is it assumes a perfect capital market where there are no taxes, no transaction costs, and no other market imperfections. Now guys, if you just turn over onto the next page, we know that the real world is anything but perfect. We are not dealing with a perfect capital market in the real world. We are dealing with an imperfect capital market. And because of that, dividend decisions may be affected by a variety of factors that make the dividend decision relevant. So in the real world, the dividend decision is not irrelevant because in the real world, we are not dealing with a perfect market. In the real world, we are dealing with an imperfect market, and certain things will affect the dividend decision. So the dividend decision is actually relevant in the real world. So what are factors that affect the dividend decision in the real world? First, all companies need to comply with statutory requirements. So statutory requirements includes things like compliance with the Companies Act and the company's Memorandum of Incorporation. In addition to that, companies also need to comply with the Income Tax Act. So if you go back to the previous page, we saw that in a perfect capital market there are no taxes. In the real world, we know that that's not true. We know if a company pays dividends, there's dividends withholding tax. In addition to that, companies also need to comply with other legal restrictions such as loan covenants. So for example, if a company's entered into a loan agreement with their bank, the bank might say, whilst the loan is outstanding, the company can't pay dividends, or alternatively, they might say, whilst the loan is outstanding, the company needs to maintain a certain dividend cover ratio. So all of those things are obviously to protect the bank to make sure that the company can actually repay the loan. So all of those things, the Companies Act, the Memorandum of Incorporation, the Income Tax Act, and any other legal restrictions need to be complied with when it comes to dividend payments. Then in addition to that, we always need to consider shareholder preference or the clientele effect. And this is extremely important. So guys, all companies should have a dividend policy that is appropriate for their activities. So because all companies are different and unique, all companies will have different requirements. So for example, we might have a company that has a lot of investment opportunities, and those investments have a positive net present value. So obviously, if the company wants to invest, they can't be paying high dividends. They need to keep the money in the company for investment opportunities. On the other hand, you might have a company that doesn't have any investment opportunities, and they decide rather to pay high dividends on an annual basis. So because all companies are different or unique, all companies will have different dividend policies. So each company needs to decide what policy is appropriate for their activities. Then what will happen? According to the clientele effect, investors will then choose investments that have a dividend policy that meets their particular requirements. Because remember, all shareholders have different preferences or different needs. High-income investors, for example, are likely to prefer companies that do not pay dividends because they are not reliant or dependent on the dividend. On the other hand, other investors, such as pensioners, might be dependent on that dividend payment. So they would prefer a company that pays dividends on an annual basis instead of capital appreciation. So the company must have a dividend policy that's appropriate for their activities, and then investors will choose investments which have a dividend policy that meets their particular requirements. Some investors don't need dividends on an annual basis. They prefer capital growth in the share price. Other investors are dependent on that dividend, so they will then invest in companies that pay dividends on a regular basis. It's important to note that investors who are in pursuit of high growth shares will obviously prefer a company that does not pay any dividends. They rather want the money to be reinvested so that one day when they sell their shares, they will benefit from the capital gain made on the sale of their shares because they are interested in high growth shares. In addition to that, guys, an investor's risk appetite will also influence their preference. If an investor is risk averse, meaning that they don't want to be exposed to risk, they don't want to take risk, they would prefer an annual dividend over uncertain capital growth. Remember, guys, capital growth is uncertain. A lot of things can change in the future, and maybe the share price of the company doesn't actually increase. Maybe the value of the company doesn't increase. Maybe the economy goes down and everything goes down with it, and when the investor finally sells their shares, they actually lose. So some investors who are risk averse and they don't want to take a risk would prefer getting a known dividend every year and getting their return in the form of dividends rather than waiting for capital growth that might not actually happen. And that's referred to as the bird in the hand theory. Obviously, the opposite is also true. If an investor is a risk taker, they might then prefer to wait for higher yet uncertain capital growth. So they will forfeit their dividends, not take dividends every year, rather let the company reinvest the money, and they'll wait for uncertain capital growth because they are risk takers. They are not scared of taking risk. And remember the relationship between risk and return. Because they are taking higher risk, because this capital growth here is uncertain, they should get a higher return. So please remember, guys, whenever you need to discuss the dividend policy of a company, shareholder preference should always be considered when companies make the dividend decision. Then lastly, we also need to look at information content or the signaling effect. So under this heading, guys, it's important that you understand many investors believe that a company's earnings and growth potential should be validated by way of dividends. So what does this mean? This means by declaring a very high dividend, that communicates that the company has performed well, because obviously if the company didn't perform well, they wouldn't be paying a dividend. So a high dividend communicates to the market that the company has performed well and that the directors believe that this will be maintained in future years. So if a high dividend is paid, the market perceives that as positive. Obviously, the company is doing well because they are able to pay dividends. They expect good growth in the future, otherwise they wouldn't be paying dividends. And as a result of that, what will happen to the share price? It causes the share price to increase. On the other hand, guys, if we have a company that has been paying regular dividends for years and all of a sudden that dividend is cut, they declare at the AGM, they tell all of the shareholders, we will not be paying a dividend this year. What do you think is going to happen to their share price? The share price is going to drop. And the reason for that isn't because the value of the company has dropped. The value of the assets and liabilities is exactly the same. The value of the company hasn't changed. However, if the dividend is cut, this is seen to be imparting negative news about the company's future prospects. So investors see there's a problem with the company, because if things were going well, you would pay a dividend. The fact that you're not paying a dividend means there's a problem, and investors perceive that as the directors are uncertain about the future growth of the company, and as a result of that, it could cause the share price to fall. All right, then before we go and look at a couple of lecture examples, please just note the last section that you need to look at under dividend policy is alternative forms of dividend payment. So please just read through this section. It's very straightforward. Just read through scrip dividends, read through the share buyback, and also read through special dividends. All right, very straightforward. Read through all of that. Let me know if you have any questions.